Hello there. Welcome to lecture 12 of the day trading model. This lecture is about trade management. Trade management is by far one of the most important things to understand once you understand where the market is likely to draw towards. The reason why trade management is so important is because without proper trade management, without proper understanding of institutional order flow, you will take losses that could be easily prevented if you would understand how to manage demo trades accordingly. Before we dive into today's lecture, I must first give you a risk disclaimer. Of course, you have already heard these risk disclaimers many times before, however, it's still important for me to repeat them since I am not a financial advisor. Everything I share in this lecture is purely meant for educational and or entertainment purposes only. If you want to read the full risk disclaimer and terms of services that you agreed upon when joining my mentorship, you can do so on the onesthatknow.com and you can find all the legal documents. Before you watch this lecture, it is very important that you understand the full model. If you do not understand and know the full model, this lecture is simply not yet for you. The reason why this is the case is because without an understanding of the next draw on liquidity, knowing where the market is likely to draw towards, why would you even consider thinking about learning how to manage your positions? The table of contents for this lecture are as follows. First of all, we're going to take a look at the A to B mindset when it comes to capturing trades. Secondly, we're going to take a look at invalidation levels. And thirdly, we're going to take a look at the psychology during trade management. First of all, we're going to take a look at the A to B mindset when it comes to longs. With an A to B mindset, I mean the following. A to B is simply price moving from point A, which is our entry, to point B, which is our target. Point A being a discount in this case because we're looking for longs, and point B being in a premium. What we are focused on within this lecture is how we can manage our position the moment that we open a position right here on point A, and how we can ride it all the way to point B to our target, and how we can recognize when this is likely not to occur. A visual representation of this is the following, where we see an arrow from point A to point B, which is our draw on liquidity. The A to B mindset for shorts is as follows. Point A is up here. This is where we go short in a premium. And point B is our draw on liquidity, which is in a discount. The move that we are looking to capture on is from point A right here to point B. During this lecture, we're going to focus on how we can recognize how this move is likely to occur or whether or not it is likely to not occur. If it does occur, this is what it would look like. To understand the concept of point A to point B more in depth, we're going to take a look at two schematics that were shared prior with you during the model series. On the left schematic, we can see the market moving from the range low to the range high, aka a market maker buy model. And on the right side, we can see the market move from the range high to the range low, aka a market maker sell model. What's very important to understand is, like I mentioned, point A is your entry opportunity, meaning point A is relative to your personal preference. However, point B is fixed. The reason why point B is fixed is because you need to understand what the draw on liquidity is. If the draw on liquidity is not clear to you, then there's no setup in the first place. So let us take a look at some potential scenarios of what point A could be and what point B could be. Point B is going to stay fixed, like I mentioned. First of all, point A could be the low risk phase within the market maker model, where we're targeting this range high for point B. We can basically say, okay, point B is right here. This is what we're going to target. Point A can be, first of all, our low risk phase within a market maker buy model. This is our low risk buy. Within a market maker sell model, this low risk phase would of course be our low risk sell right here. Market reacts off a point of interest, this place is lower, retraces. This right here is a potential short opportunity. This is where some traders might go short. The low risk phase is, in my opinion, a very nice phase to enter in within any particular market maker model. However, it's possible that this doesn't suit your personality, that you would much rather wait for more confirmation of order flow in fact delivering like you would anticipate it to deliver. So what you could do is wait for another displacement leg. And if you would wait for another displacement leg, the entry would move from where it is currently at, meaning where point A is currently at, to a falling retracement. So then it would look like this, where we see point A move from this low to this low, and on the right side from this high to that high. This stage is what we call our first stage of accumulation within a market maker buy model, and within a market maker sell model, it's our first stage of distribution. What stage you enter on is simply a result of your personal preference and what you feel most comfortable with doing. I cannot tell you that this is the best phase to enter on, and that, for example, the low risk sell or the low risk buy is better than the first stage of distribution or accumulation, because that is simply not true. If you are able to recognize reversals with a high degree of accuracy, then the low risk phase might be the best thing for you. However, if you need more confirmation of a reversal being in, then that second stage, or that second entry opportunity I should say, is probably better. And there's even another entry opportunity later down the line, which is of course right here for the market maker buy model, and for the market maker sell model it's right here. The moment that price displaces and expands in your anticipated direction, and the range from your potential new entry to the drawn liquidity point B is too small, there's no entry opportunity anymore, and you need to wait for more market data. You need to wait for the next opportunity to come around. And this is where the majority of people do not have the right mindset. They think that the opportunity that they're seeing is the final opportunity, and they think that they need to get in now. So what do? They buy in a premium or they sell in a discount. And the number one rule that I've shared with you is that you never do that. It's as simple as that. However, the moment the price reaches our drawn liquidity and we see signs of reversal potentially taking place, some might be intrigued by capturing the reversal or retracement. This is something that people can do that have a contrarian mindset, meaning they like to do the opposite of what the high time frame order flow is doing. Even though the high time frame order flow is bullish, they would like to go for shorts. Even though the high time frame order flow is bearish, they would like to go for longs. This is possible and there's nothing wrong with that, but this is how you do it. You wait for price to reach a drawn liquidity for a buy program, and the moment that you recognize signs of the market potentially turning around and a change in state of delivery occurs for a sell program, you can go short in that first retracement higher, this is your point A. However, as you can notice, point B is not on the opposite side of the range. Why is that the case? Because the opposite side of the range might be too far. If you're trading against the higher time frame order flow, the most safe thing to do is to take a big partial, if not a full close, at equilibrium of the range. That's why I've shared with you that point B is at equilibrium of the range if you're trading against the higher time frame order flow. Let us now take a look at invalidation levels. Invalidation levels are, in my opinion, pretty easy. However, when you're completely new to looking at the markets the way that I'm teaching you to look at them, it can be quite challenging. And the reason why that's the case is because you're worried about not doing the right thing, you're worried about getting in too soon or getting in too late, and you see the market move one small tiny fluctuation against you, and you immediately want to get out, and there's simply no real logic behind why you're managing your positions the way that you are currently managing them. I'm now going to share with you the most objective manner possible that is very simple to apply to manage positions. Again, this is not financial advice. I'm not telling you to do this yourself on any live account. So let us take a look at this. If we have established an entry at point A, and this is for example our low risk sell, and we see the market displays lower and it retraces into this CB, a high forms. The market then displaces lower below this low. The moment that price trades above this candle's high right here and we see displacement above that high, meaning, for example, a very obvious close above it, then we can basically already say, let's cut the position. Or let's take a big partial. And that partial itself is not going to be in a big profit because your entry was at point A. However, it is better to get out in close proximity and to break even with a big part of the position or even the full position if the order flow is not supporting your idea than fighting against it. Because imagine getting a warning sign in your mind when you see this displacement leg higher and not taking anything off of your short. Just imagine the market drawing all the way higher to your stop loss. What would that feel like? Wouldn't you feel stupid for not having taken a partial when you recognized that the order flow was potentially not in your favor and that the smart money reversal was potentially not in yet? Of course you will feel that way because you saw that alarm sign. You saw that warning. And that's why it's very important to listen to the analyst. And the moment that your bearish array, your premium arrays, are not acting as resistance on price, and you will instead see highs getting violated that should not be violated, you need to give yourself permission to get out. Either with a very big part of the position or the full position. And how many times have you felt this, where you saw signs that the market might potentially turn against you, might turn against your position that's currently in profit, but you were just too greedy and you weren't able to think logically. That's why it's so important to give yourself permission and to understand what proper invalidation levels are. And this is one of them. The moment that you have an entry established and you see displacement to lower and a high forms inside of the CB that formed during that displacement leg, that high should never get violated the moment the price displaces to lower again. This is of course a bearish scenario. However, let's say that the market displaces lower and it forms another high. This high forms again in a CB. The market displaces lower, but instead of drawing towards point B, the opposite side of the range low, it turns around and it trades above this high that formed here, and we see displacement above it. Again, this is a warning sign that should go off. Why? If price traded into a discount of the current range, you need to visualize for yourself where 50% of this current range is. If it traded into equilibrium, into potentially even a discount, and you see this scenario occur, you need to be very careful. Because if it was going to deliver towards the opposite side of the range, it would have moved with speed and velocity below equilibrium of that range. If it does not, again, please be careful. So the moment the price displays above this high, an alarm sign, a warning sign should go off that signals to you, okay, order flow might not be going to deliver as how I thought it would deliver. So let us just take a big partial and think about it this way. You're in profit. Your entry was up here. Why are you struggling with getting out of a position? It's because you're too greedy and you already imagined how much money you could make when price would draw towards point B, so you're emotionally attached to the outcome of this position. Yep. Many of you don't realize this, but this is the reason why you're emotionally so driven the moment that you open up a chart and you open up a position. It's not simply, okay, the market moves up and down, up and down. That's how the market moves. No. What you're doing is projecting your own feelings. And there's so many feelings that we as humans experience, especially when money is involved, especially when we know what the outcome could be of this trade that we're currently in. And that's exactly what we need to avoid. And that's why we need to make our management process as mechanical as possible. And we need to have clear and validation levels for our positions. If we take a look at the long scenario, it would look like this. The market, first of all, offered us our entry opportunity right here and expands higher. The market then retraces and we see a low form. The market then expands higher again and it displaces above this high. The moment that we see displacement below this low, we need to be very cautious of the market potentially rolling over, drawing towards our entry and potentially lower. The reason why this is the case is because in bullish order flow, you never want to see displacement below lows that formed inside of imbalances, inside of BCs. What's very important to note is that you need to understand that I'm saying displacement. What do I mean with displacement? With displacement, I mean a clear signature of price violating the low. Because this low could be a higher time frame imbalance, its respective high. What we then could see is that the market draws into that higher time frame imbalance, forms a low, and then begins to run. That's why you need to be actively managing a position and you need to be using a wider stop than simply just putting it on this low. Because you will else experience what I just described to you, where a higher time frame retracement is simply a lower time frame, so to say, purge on liquidity. But because you're so focused on that low not getting violated, you want to trail your stop here, market takes you out, and then it runs. So you just became the liquidity. That's of course something you want to avoid. And that's why I would highly suggest you to leave your stop where it is, but instead use manual closes to determine whether or not you should get out or stay in. If the market displaces higher and we see a new low form inside of this expansion leg, inside of this BC, we would of course never want to see the market expand and then clearly displace below this low right here. Why? Because that low formed inside of that imbalance. You might be thinking right now, okay, Zeus, it's all fun, these schematics. How can I apply this in real time? How can I utilize this information? First of all, I'm not saying that you should, because of course I'm not a financial advisor. However, I am going to showcase to you how I am able to manage my positions the way that I manage them based on this information. And I'm going to share with you what I'm thinking whilst I'm trading. And you will not hear any sense of, okay, this is how much I'm risking, this is how much I'm potentially gonna make. No, I'm simply focused on, am I doing the right thing right now? Am I managing this position, which is completely according to my model, the right way? If I am, I'm doing well. If I'm not, I'm doing wrong. Let us now take a look at the psychology that is required during the management of a position. For this part, I will showcase some live executions and break down my psychology whilst being inside of a position. I think this is the best way to understand this topic because I am a big believer that you physically need to understand how someone could think whilst being inside of a market maker model. It's all fun to look at schematics and to basically get an understanding of how the market should deliver. However, of course, a schematic is simply something that someone drawn, and this is an ideal representation of how the market should deliver. However, as we all know, the market doesn't always deliver that clean, and there are still opportunities that are present because all rules get basically followed, meaning all checkboxes get checked that lead to a position being taken on. However, to then be able to still manage it accordingly is something that we need to learn by looking at the live executions. So let us take a look at a few live executions and I will walk you through the whole process of managing the position. We're going to take a look first of all at an execution that I took on the 27th of March 2024. As you can see, I went short on the Nasdaq inside of an inversion reverse gap. The entry is of course point A, as we know. I was anticipating big down close candles to come. At this point, my stop is inside of this gap right here, because that gap should stay open now that we've displaced below this gap on the left side of the curve. I'm monitoring to see whether or not this BC is going to continue to act as an inversion of a value gap on price. As long as it does, I'm anticipating lower prices since that is my strong liquidity for this PM session. I'm not looking at anything right here on the right. I'm not looking at the amount of ticks going up and down. If you are someone who is easily influenced by numbers changing, what I would advise you to do is, if you execute through TradingView, to turn the monetary amount off and to change it into ticks. If you would see a P&L floating right here, it's very easy to get distracted by that. Now that we have seen this displacement leg lower, below this low right here, which set up the retracement into this inversion gap, I would never want to see price trade above this high anymore that formed at my entry exactly. So in my mind, I already trailed my stop to break even. So basically, the moment that price displaces lower, I already know that my targets are likely to be met for this afternoon session, or I'm going to get out at break even. At that moment, it's a very nice feeling because all emotion is already removed. Why? Because there's no risk anymore. It's just either break even or it's big profits. It's as simple as that. However, you need to be cautious for not trying to get into that mindset too soon. So you need to apply technical understanding of institutional order flow to basically guide you into trailing your stops accordingly. And as you can see, the market retrace into the CB set form here, and I'm simply monitoring whether or not those CBs are going to act as resistance on price. As long as they're acting as resistance on price, I'm all good because I know that lower prices are likely to be next. Here you can see me annotate the highest CB. Remember, my stop is above this high. Of course, I did not trail it, as you can see in the execution, but in my mind it is. And there the market displaces to the first target right here, the sales liquidity objective. I partial there. Why? Because it's a potential reversal zone since it's the previous cycle low. And as long as this big down close candle functions as resistance on price, I'm anticipating lower prices. You might be wondering why that big down close candle. Well, you could say previous cycle low is this candle, right? Yes. However, this big down close candle has more significance to it, in my opinion, because it is a bearish breaker. High, low, higher high. Last down close candle, bearish breaker. Notice that this low is also important. It's the same logic. And Again, now in my mind, I'm simply looking for those two respective lows to act as resistance on price. I would never want to see the market displace above this high anymore now that we displaced the lower below the low that set up that retracement. And eventually you can see that the market takes me out, and that's that trade done. So what I want you to take away from this recording is that every single time that the market displaces in my favor, I'm trailing my stop to the newly generated or newly created high. This is something that I'm patient with doing, so I first wait for displacement, and once the displacement has done, I look for new premium rates that should act as resistance on price. We're now going to take a look at a long that I took on the 9th of April 2024. This was a market maker buy model. As you can see, I went long inside this bullish breaker, and I was targeting this buy side liquidity up here. The logic behind this trade itself is not that important. However, it's important to note that I expected this to be the low and that a reversal was likely to take place. So the moment that I see displacement higher, I can simply go long in this upclose candle, which is a bullish breaker. My stop can be below that bullish breaker's low. Notice that this lines up with a low that formed inside of a BC right here. What I'm now expecting is I'm expecting all of the premium rates on the left side of the curve to basically get violated and to begin to act as support on price. Again, I'm not monitoring the amount of ticks floating. I'm simply looking at whether or not these candles are delivering like they should deliver. And I'm monitoring every single array on the left side of the curve and every single specific price level that I'm looking for, of course, to see if they're getting violated. Because I know that if we're in a buy program, all of those price levels should get violated and begin to act as support on price. That's a rather advanced way of managing positions. But it's, in my opinion, the best way to manage positions because it shows real order flow. Remember, my eye is drawn to the buy side liquidity above this high and these highs right here. That's my target. In my mind, I've already trailed my stop again because we displaced above this high now. This high is a crucial high because this high set up the run lower into this sell side liquidity and into the previous cycle low. So price should never fall below this candle's low anymore, but more specifically below this low that set up that expansion leg and that formed inside of that imbalance. So again, at this point, it's simply a matter of time before the market either delivers or takes me out at break even. It's a very chilled and calm place to be in, and it's my favorite part of the trade because it just allows me to relax and simply witness the beauty of algorithmic price delivery. The next premium array I'm monitoring is this premium array right here, which should get violated with speed and velocity if the market is in fact going to deliver higher. Notice, by the way, that this reversal occurred during our time of interest for the afternoon session. Or during a time of interest, I should say, because we of course have multiple times of interest. Now I'm just waiting for that final expansion leg to come, since order flow is obviously bullish because all premium rates on the left side of the curve are getting violated with speed and velocity. Here you can see me take a partial above this buy side liquidity right here, which was the previous cycle high, and the market eventually delivered into my target. Again, rather simple logic for managing the position, because it's simply a matter of spotting if the order flow is on your side or not. If the premium raise would not get violated, like they were getting violated, then that would signal that, okay, be careful here. And if then a displacement against a crucial low would occur, then that would put my mind immediately at, okay, maybe the low isn't in yet, and maybe my analysis is off, so I need to get out. The third and final recording that we're going to take a look at is a long that I took on the 18th of April 2024. The live execution plus voiceover of this is available on the mentorship, so if you want to hear or listen to my full psychology whilst being in this position, you can do so there. However, for this position, what's very important to note is that I went long inside of this BC. So in my mind, the moment that price displaced above this high right here, I'm immediately looking at whether or not we're going to see continuation occur. Why? Because I'm anticipating higher prices. So price should never fall below this low again. And this low formed inside of that BC, inside of this upclose candle, inside of this bullish breaker. And therefore, I'm utilizing multiple confluences to help me gauge order flow. This blue box was a 5-minute inversion for value gap. And now that price closed above that 5-minute inversion value gap price range, we can see it having trouble with the 9:30 opening price. The 9:30 opening price is a very important reference point during the morning session, and that's why you see me always or hear me always talk about it, because it's an important reference point. It's okay for the market to have some struggle, so to say, with displacing through that. As you can see, I have annotated CE of that blue box now, of that inversion value gap. Price could potentially trade into that and deeper into this down close candle, but it doesn't have to eventually. Again, the stop is drilled to the low right here. If you would understand what a breaker pattern is, you would see that right here, where we see a high form, a low inside of a BC, higher high. So if price would form a lower low there, I need to be very cautious, because that could be a bearish breaker being set up, but also the following. It could be my market structure shift pattern playing out. As you can see, we are seeing very messy delivery here. And the moment that price displaced above the 9:30 opening price, closing above it, and then trading lower so aggressively, I trailed my stop to this low right here that formed inside of this down close candle. Why? Because if order flow in fact is bullish, we should never see price trade lower again after trading above the 9:30 opening price so aggressively. Because think of it this way. If we know that the 9:30 opening price is a very important reference point for determining whether or not we're going to see buy side or sell side delivery next, we don't want to see the market trade above that opening price, meaning trading into a premium and then displacing lower. No, we want to see it begin to run soon. And now that we saw that closure above the 9:30 opening price, my stop can immediately be trailed to the low that set up that closure, that sign of speed and velocity above it. Price is now trading above the previous cycle high. So what I'm doing is I'm annotating that full up-close candle. And the reason why I'm annotating that full up-close candle is because that up-close candle set up the run lower, and the size of that up-close candle is big enough for me to deem it as an important reference point. Where you saw me earlier not annotate the previous cycle low candle, but instead the candle next to it, you can see that there's no big candle next to this up-close candle. So, what is the important reference point? The bullish breaker is this candle with a long wick on the upside and a long wick on the downside. So if you made it this far to the lecture, you just basically learned a gem for when to look at a previous cycle low or high as important reference points. The size of the candles matters. Even though a small candle might still function as support or resistance on price, you ideally want the previous cycle high or low to be of a specific range. Here you can see the executions, and eventually the market expands beautifully above this high towards the London high, which was this high. What I want you to take away from these three executions that you just witnessed is how I'm mentally preparing myself to get out the moment that price displaces against my favor. But as long as price does not displace against my favor, I know that we're in a buy program or a sell program, as you already seen during the first execution video. So as long as those displacements do not occur, and we instead see displacements occur in the right direction relative to the execution idea, then I know that order flow is on my side and I know that I should stay in. And that's the main takeaway from this whole lecture. It's all about understanding how the market should move from point A, which is your entry, to point B. If you're able to understand that right there, man, beautiful. Entering is the easiest part. You need to understand the draw on liquidity, and when that is clear, all it takes is recognizing the reversal and pressing or buy or sell on the demo account, of course. I want to give you a homework assignment to finalize this lecture. I want you to practice determining invalidation levels when backtesting. You have probably only been looking at basically reversal patterns, getting to know the model, getting to understand it, but you should now start paying attention to what occurs between your entry and the strong liquidity being reached. It's not just, oh, look, the market delivered and therefore we should count that as a win. No. What I want you to do is I want you to study the whole delivery from point A, your entry, to point B, and start annotating what the invalidation levels were during each displacement leg into your favor. Secondly, I want you to practice getting out of a demo trade when institutional order flow is not aligned anymore with your idea, with your anticipated strong liquidity. This is something you need to practice, and this is something that will take a lot of time to get used to. But once you do, you'll get to a state of freedom that will be very calming for yourself, because it makes you understand that it's simply a matter of fact that you need to do the right thing consistently, and eventually that will turn into great executions. And that, of course, does not guarantee profitability, and it's something that I cannot guarantee at all. You are the reason why you become profitable. The only thing I can do is share with you what works for me, and this is exactly what does. So with that, this lecture comes to an end. This was lecture 12 of the model series. We're closing in towards the end of the lecture series. After this series, I will be releasing a new series where I'll be taking you with me into the markets, showing you my full routine consistently, meaning from the moment I open my charts to determining whether or not there's a setup, to actually taking the setup, to basically walking away. With that, this lecture comes to an end. I hope that you found it insightful. During the next lecture of the model series, I want to touch on the most common psychological problems that one could experience when understanding the model and when learning how to trade. Be safe.